how do you even begin to make sense of the stock market? I mean, it can feel like this chaotic, overwhelming place, right? Full of noise and confusing advice.
Oh,
You're
absolutely.
trying to build wealth, but how do you do that without just feeling like you're, well, gambling?
It's the timeless challenge, isn't it?
Yeah.
And for decades, one name has consistently offered a path through that chaos, a framework built on common sense and long-term thinking. Benjamin Graham.
Exactly. That's why we're going to take a deep dive today, not into the huge original text of his classic, The Intelligent Investor, which is
Or
massive.
it's the doorstop.
It is, but into a really helpful, detailed summary created by Preston Piss and Stig Broderson.
Yeah, think of their summary as getting the absolute essence of Graham's wisdom. They've extracted his core principles, his timeless advice, filtering it specifically for you, the modern investor.
But staying true to Graham.
Oh, completely. Staying absolutely true to Graham's original insights, especially in that crucial 1970s revision he did.
Okay, so our mission today is basically to unpack the most important nuggets from this summary. We want to understand the heart of Graham's enduring strategy, see what was key in his thinking back then,
Mhm.
and figure out how these powerful ideas are still incredibly relevant for you navigating today's markets. We're trying to cut through everything else to get to what's truly essential.
Okay, let's start at the absolute foundation Graham builds upon. He draws a very sharp line, a crucial distinction between what he calls investment and what he calls speculation. Why is that line so important to him?
It's the starting point, really. Graham says a speculator. Well, they're essentially trying to guess market fluctuations. They're hoping to profit purely from price movements,
Yeah.
jumping in and out based on predictions.
Right. Whereas an investor,
An investor, on the other hand, is focused on buying and holding suitable securities at suitable prices. They look at price movements, yeah, but primarily to find those suitable prices where they can act on value, not, to time the market.
and Graham had seen firsthand where pure market enthusiasm, that speculative mindset, tends to lead.
Straight to disaster. Yeah, he's pretty clear. There are no easy or automatic paths to riches on Wall Street. None.
And here's a point that often surprises people. Graham insists that successful investing doesn't actually require some stratospheric IQ.
Wait, really? But everyone on Wall Street seems, incredibly sharp.
He argues that intellectual capacity is less important than having the right temperament. What it does require, he says, is implementing a sound, rational strategy which his book provides.
Okay.
And perhaps even more critically, having the emotional discipline, the ability to control your impulses when the market gets wild.
That makes sense. So who was Graham writing this book for? He identifies two main types of investors, doesn't he?
He does. On one hand, you have the defensive investor, sometimes called the passive investor. Their primary goal is capital preservation, avoiding serious losses. They want safety and really value not having to constantly fuss over their portfolio. Freedom from bother, he called it.
Freedom from bother. I like that. And then there's the enterprising investor.
Right, this is someone willing to put in the homework, the time and effort needed to analyze and select securities that might be a bit more complex or offer potentially higher returns, but they require more active management.
Okay. So now, Graham spends a lot of time on the market itself, and the summary authors really highlight Chapter 8 as key. What's the big message there about market fluctuations?
That they are going to happen. That's the big thing. Price swings aren't an anomaly. They are probable and frequent. And the intelligent investor must be prepared, not just financially, but psychologically to handle them.
Psychologically, yeah. And what's fascinating is his perspective on how you should view the market once you're invested. He uses this great analogy.
Business partner one.
Yeah, you're like a business partner in a private company. Would you expect daily price quotes for the entire business? Would you constantly be looking to buy out your partners or sell your stake just because the paper value changed?
Probably not. It seems absurd when you put it like that.
It really does. It's a powerful shift in perspective. It means you're virtually never forced to sell just because the market price dropped.
Right.
And Graham takes it further. Watching the market price too closely can actually hurt you, leading you to make impulsive decisions completely contrary to your plan. He even suggests you might be better off remaining ignorant of the daily noise sometimes.
Yeah, turn off the ticker.
Yeah.
He's particularly blunt about trying to time the market,
Mm-hmm.
predicting whether it will go up or down next.
Oh, yeah.
He calls it absurd to think that the general public can ever make money out of market forecasts. Instead, he emphasizes pricing acting when the value is right, not when you think the market is headed a certain direction. Timing only works for the investor if it happens to coincide with a sound pricing decision.
Okay, so the classic wisdom is buy low, sell high. The summary notes the truly shrewd investor did this, bought in the despair of a bear market and sold in the euphoria of a bull going against the crowd.
Right, the contrarian ideal.
But Graham modifies this for the average investor, right? Since forecasting is so hard.
Exactly. Instead of trying to perfectly time the top or bottom, which is, let's face it, nearly impossible, Graham suggests a more systematic approach, altering the proportion of your stock and bond investments.
Rebalancing based on market levels?
Kind of, at what seems like a favorable moment in real time based on your current assessment of the cycle without needing perfect hindsight. It's about adjusting your risk exposure as market levels change relative to, say, historical norms.
And it's worth noting, as the summary authors do, that Graham wrote before capital gains tax was such a big deal.
Right, that wasn't really part of his calculation there, which definitely affects how you'd apply that today.
Definitely. So how do you handle those inevitable market rises? That's when the temptation to do something, often something rash, is strongest, right?
Oh yeah, human nature is the toughest part. Graham's guard against this is a bit like portfolio rebalancing, but tied specifically to market levels. As the market goes up, your stock allocation likely grows, becomes more valuable. He suggests selling some of those highly valued stocks and reinvesting the proceeds into bonds. You then, reverse this process in a declining market.
So it's a practical way to counter your own psychological biases, that fear of missing out or panic selling.
Exactly. It forces some discipline.
Okay, so that's the mindset and the broad strategy. What about the actual building blocks, the different types of securities? Graham offers guidance on bonds, though it's important, as you said, to view this through his 1970s lens.
Absolutely. He talks about taxable versus tax-free bonds, which is really a numbers game based on your tax bracket. But the big decision for you to the investor, he said, is short-term versus long-term.
And what did he like back then?
For the small investor, he really liked U.S. savings bonds, Series H&E specifically, because they guaranteed your principal, your interest, and you could always get your money back. Safety was paramount for him there.
Makes sense for a defensive approach.
Totally. He also covered other types, U.S. Treasuries, state and municipal bonds, where the yield is obviously linked to safety rating.
Lower rating, higher yield, usually.
Right. And corporate bonds, same principle. Higher yield usually means lower safety. A key piece of advice he gave, though, was to avoid callable bonds.
Why is that?
Because the issuer will only call them, meaning buy them back from you early when interest rates have fallen, which is exactly when you don't want to get your principal back because you can't reinvest it at the same high rate. It works against the investor.
Okay. What about preferred stocks?
He was much warier of street preferred stocks.
Mm-hmm.
He cautioned against them unless you could get them at a significant bargain price, because companies can simply choose not to pay preferred dividends if things get tight.
Oh.
And with non-cumulative preferreds, if they skip a payment, you lose that dividend forever. It doesn't stack up. So, big risk there.
But he saw some opportunity in lower quality stuff sometimes.
Yeah, interestingly, he noted that second-grade bonds and preferreds those lower quality issues, while riskier generally, could become suitable for an enterprising investor buying them at a marked discount during a downturn.
Why would you do that?
Because if the market recovered, most of them would likely recover significantly too, offering a large potential gain from that depressed price. His common sense rule was basically, don't pay $100 for something if you know from history it might trade at $70 in a bad market. Look for that discount.
Got it. He also touched on foreign government bonds.
Briefly. Historically, they had some reputation issues. He cited examples like Cuba's pre-revolution collapse. His practical suggestion for most Americans back then, just probably stick to domestic investments. Keep it simple.
And new issues, IPOs and things like that.
Be very cautious. That was his advice. New issues in general, stocks or bonds being sold for the first time. He saw them as typically driven by salesmanship, structured to favor the seller, because they're often launched when market conditions are good, meaning prices might be high.
Especially for smaller companies.
Especially, he felt, for new common stocks of small, formerly private companies launched on an upswing. They might struggle or not even survive a downturn. A red flag, he pointed out. Seeing new small company issues priced higher than established, major players in the same industry. That shouldn't happen if value is the guide.
Okay. Now, Graham was writing during a time of significant inflation, right, the 70s, so he tackled that directly. What were its historical effects, he noted?
Yeah, loss of purchasing power, obviously. which is particularly tough on fixed income investors, people living off bond interest, for example.
Right.
The common assumption back then was that stock values must rise with inflation to compensate. But Graham, looking at the data up to 1973, gave a pretty blunt no to the idea that common stocks would necessarily do better in the future just because of inflation.
Really? That's surprising.
He didn't see a tight, predictable link between inflation or deflation and common stock prices. They didn't always move together reliably.
Huh. And why was that? Did he look at corporate earnings?
He did. He dug into why corporate earnings weren't really keeping pace with inflation either. Factors like rising wages, outpacing productivity gains, the constant need for capital reinvestment just to stand still, and especially mounting corporate debt.
Debt was a big issue.
Yeah, he showed how the ratio of earnings before tax compared to total debt had worsened significantly from 1950 to 1969. So inflation wasn't automatically benefiting shareholders in terms of real profit growth in that context.
So for the average investor, based on his analysis then, you shouldn't just expect stocks to automatically beat inflation. Fluctuations are the norm, not smooth growth tied to rising prices.
Pretty much. Don't count on it as an automatic hedge.
Did he look at other potential inflation hedges besides stocks?
Briefly, gold, he noted, historically didn't produce investment income, so it was more of a store of value. Art and jewelry were tricky, really not for the average uninformed person. Real estate, on the other hand, had shown itself to be a more reliable hedge over time, though it certainly has its own cycles and issues.
Okay, let's pivot to stock selection itself. Graham was actually a big advocate for including common stocks in a portfolio, even back in 1949 when they had a bad reputation after the crash.
Right, he saw their long-term value potential.
But by the 1970s, after a long bull market, their very success had created what he saw as an illusion of safety. People forgot how long it took to recover from 1929.
Exactly.
Yeah.
And high prices meant stocks had lost their traditional yield advantage over bonds. At a Dow Jones level around 900 in 1971, he had, quote, no enthusiasm for common stocks, signaling a need for a defensive posture.
And for that defensive investor, Graham laid out specific criteria, didn't he? 7 requirements for selecting common stocks in Chapter 14. These are all about being conservative, safety first.
Absolutely. These criteria are designed to filter out riskier companies. He looked for, let's see.
Go through them.
Okay. 1, adequate size, big, established companies, not tiny startups. 2, strong financial health. Simple things like current assets being at least double current liabilities, basically. Can you pay your short-term bills easily? Right. And long-term debt not exceeding working capital. For utilities, he had specific debt-to-equity rules. He saw weak financials as the most concerning deficiency.
Okay, what else?
3, earnings stability. Has the company consistently made some money, even a little, over the past 10 years? No big losses wiping out capital. 4, dividend record. Has it paid dividends without interruption for at least 20 years? That shows financial strength and commitment to shareholders.
20 years is a long time.
It is. 5, earnings growth. He wanted to see a minimum increase in per-share earnings, like maybe a third over 10 years, using 3-year averages at the beginning and end. Just proof of some progress.
Moderate growth.
Moderate growth. 6, moderate price earnings, PE ratio. The price you pay shouldn't be more than 15 times the company's average earnings over the past 3 years. Avoid expensive stocks relative to current earnings.
Keep it reasonable.
And 7, moderate price-assets ratio. The price shouldn't be more than 1.5 times the stock's book value, basically, what the company's assets are worth on paper. Don't pay too much above the tangible value.
Wow, that's quite a checklist. And the summary authors point out how much easier this is today with stock screeners.
Oh, absolutely. You can filter thousands of stocks in seconds based on these rules. Back then, it was digging through manuals.
It filters out a huge universe of stocks immediately, focusing you on the conservative end.
It really does. And Graham highlighted public utilities back then as often meeting these criteria. They were effective monopolies, could adjust prices for inflation usually, had modest PE ratios, and stable prices, made them suitable for the conservative investor of that era.
Right. Context is key. What about railroads?
He wasn't a fan pre-1973. He noted their struggles, high costs, competition. He felt there was, quote, no compelling reason to own railroad stock at that specific time.
Okay. Let's talk about trying to pick winners, though. Selectivity. Every investor wants to outperform, but Graham was pretty skeptical about the average person's ability to do this consistently, wasn't he?
Very skeptical. The summary even mentions the efficient markets hypothesis in this context, the idea that prices already reflect all available information, making outperformance through analysis very difficult.
And Graham distinguished between Prediction, trying to guess the future, qualitative stuff like management quality, prospects, which he thought required great skill and was often wrong.
Right. And protection, which was quantitative analysis, looking at the numbers, the price paid, and crucially, that margin of safety we'll come back to.
He was firmly on the side of protection, the quantitative approach.
Definitely. He prioritized measurable value based on figures over intangible factors or uncertain promises, often favored by analysts focused purely on the story or the management team's charisma.
What about investment funds like mutual funds? He discussed those in Chapter 9.
Yeah, his take was interesting. He felt that the average individual stock picker actually did worse than someone just putting their money into a fund. Yeah. He saw funds as useful for promoting saving and investing habits and maybe protecting uninformed individuals from their own speculative urges. He guessed that large funds would likely just match the market index because, well, they are the market, essentially holding everything.
But the summary authors add a crucial update here, right?
They do, and it's important. Current evidence suggests that most actively managed mutual funds actually perform worse than broad market indices like the DJIA or S&P 500, especially after you account for their fees.
So they don't even match the market, most of them.
Not consistently, no. So while funds might still serve that purpose for small investors who might do even worse on their own, and as a safeguard against pure speculation, automatically expecting outperformance from a fund manager is probably unrealistic.
Okay. Growth stocks come up repeatedly. How did Graham define them?
Basically by their past track record and the expectation of continued outperformance compared to average companies.
But he flagged risks.
Big time. High prices relative to current value, the difficulty and errors inherent in forecasting future growth, and the simple reality that rapid growth rarely lasts forever for any company. Things slow down.
Did he look at how growth funds actually performed?
He cited studies from his time showing growth funds often performing similarly or even worse than broad indices over various periods. His conclusion: the average investor trying to pick individual growth stocks probably wasn't going to beat professional fund managers doing the same thing, let alone beat the overall market.
And growth stocks often come with more volatility.
Much wider price swings, typically, meaning higher risk, especially the higher the price gets, relative to fundamentals. Graham noted that while huge fortunes are made in growth stocks, these are often tied to insiders or people deeply involved with a single company for years, not the typical investor buying shares on the open market.
So this leads back to Graham's core focus, doesn't it? Bargain issues.
Exactly. Value investing at its heart. Stocks, or sometimes bonds, selling significantly below their intrinsic or real value. Ideally, he looked for situations where the estimated value was at least 50% greater than the price you paid.
That's a big discount. Where do you find these?
Often in depressed markets. When problems get exaggerated by fear and stocks are oversold despite having underlying value, it takes courage to buy them.
And what do you look for in those beaten down companies?
You needed to see underlying stability, maybe not great recent performance, but stable earnings over the long haul, solid financials, decent management, things that suggested the company could actually recover. Stocks trading below their tangible asset value, their book value, were classic opportunities he looked for.
Are these still around?
He acknowledged they were harder to find than in his early days, but yes, they still exist. Often in less followed secondary companies rather than the huge, well-known industry leaders where prices are more efficient.
And why would an undervalued stock eventually see its price rise? What are the catalysts?
Graham listed a few possibilities. A high dividend yield might attract buyers. Retained earnings could accumulate, increasing the intrinsic value over time. The stock might simply catch up during a broader bull market. New management could turn things around. Or the company might become a buyout target because it's cheap. He did note these deep bargain opportunities were less common in bonds than stocks.
Okay, let's move into security analysis for the lay investor, Chapter 11. Graham gives us a peek behind the curtain of how analysts actually work, right?
Yeah, he demystifies it a bit. For bonds, he offered a simple rule of thumb. Earnings per share, EPS, should be at least 3 times the per share fixed obligations, like interest payments. Basically, can the company comfortably cover its debts from its earnings?
Simple coverage ratio.
Pretty much. For common stocks, the analysis involved estimating future earnings and then applying a capitalization factor, or cap rate, to arrive at a value.
Now, the summary brings in Warren Buffett here, explaining his preference for using a discount rate instead of a cap rate. What's the difference?
It's related, but a discount rate approach, like in a discounted cash flow model, explicitly accounts for the timing and growth of future cash flows, bringing them all back to a present value. Graham's cap rate was a simpler multiplier applied to current or normalized earnings.
And Graham had his own famous formula for growth stocks.
He did. Value. Current earnings times 8.5 plus 2 times the expected annual growth rate. But he himself warned about its limitations. Forecasting growth accurately is incredibly difficult. Forecasting interest rates, which affect valuations, he called almost presumptuous.
So even with a formula,
You still desperately need that margin of safety. The formula is a starting point, not an oracle.
he touches on industry analysis too.
Briefly, leaders in an industry often do better, sure, but everyone knows who the leaders are, so that's usually reflected in the price already. Getting familiar with new developments might give you an edge, or it might lead you down a rabbit hole to failure. That's an individual judgment call with inherent risk.
And he described analysis as a two-part process.
Yeah, first, you sort of assume conditions remain unchanged for a period, say 7 years, and value the company based on that past performance baseline. Second, you analyze how future conditions might deviate from that baseline, what could go better or worse.
So number crunching and then judgment.
Exactly. He saw it as needing junior analysts doing the detailed work and senior analysts making the informed judgments about the future probabilities.
Chapter 12 gets into accounting nuances, the stuff that can mess with reported earnings per share. What kind of things?
Things like special charges that it might be one-offs, how companies choose to write off R&D costs quickly or slowly, different inventory valuation methods like FIFO or LIFO, which can impact reported profits, especially during inflation, or even paper losses from currency fluctuations.
Do these matter much?
He points out that many are small individually, but investors need to be aware. Some accounting maneuvers, while technically legal and following the rules, can be, let's say, highly deceptive if you're trying to understand a company's true, sustainable earnings power.
So what's his recommendation?
Use average earnings over a longer period, like 7 to 10 years. That helps smooth out temporary fluctuations in accounting choices, giving you a more realistic picture of the underlying business performance. He also stressed that calculating past growth rates is an art, and being too optimistic about projecting that growth forward just increases your risk.
Yeah, he put this analysis into practice by comparing companies.
Right, looking at pairs of businesses maybe in the same industry that seem similar on the surface but have different financial characteristics or performance records when you dig deeper. This helps expose important nuances.
What were the key takeaways from doing that?
The importance of buying at low or reasonable multiples relative to both net assets, book value, and earnings. Understanding how effectively a company actually turns its revenue into real profit for shareholders. And a strong warning against paying too much for goodwill, that fuzzy amount by which the market price exceeds the tangible book value. He was wary of paying for intangibles.
Which brings us, finally, to the absolute heart of Graham's philosophy, right? The bedrock principle he called the secret of sound investing.
Yes, the 3 most important words.
Margin of safety.
That's it. It's simply the difference between an investment's intrinsic value, which for stocks is fundamentally based on its earnings power relative to its price, and the price you actually pay for it.
How did he illustrate that?
He contrasted the market in 1965, where average stock earnings yields offered a significant buffer, a comfortable cushion, over safe bond interest rates, with the market in the early 1970s. By then, stock yields had fallen and bond yields had risen, so they were much closer. That historical margin of safety, by that measure, had largely disappeared.
And why is it so crucial? Why is this the secret?
Because you cannot perfectly predict the future. No one can. Margin of safety isn't about guaranteeing profits. It's about protecting yourself against the unexpected downturns, against adverse developments, and just as importantly, protecting yourself against your own inevitable errors in judgment or calculation.
So it's a buffer for bad luck and bad decisions.
Exactly. And he warned, the biggest risk isn't necessarily paying a fair price for a high-quality company. The chief hazard is paying a high price for low-quality or even just average companies during good times, when people mistake general prosperity for individual stock safety. Finding that margin requires looking at a company's performance over years to assess its stability and predictability.
How does this relate to growth stocks? They often look expensive based on current earnings.
Right. The growth stock investor, Graham argued, is essentially substituting an expectation of high future earnings for a visible margin of safety today based on current figures. He said this can be valid,
Mm.
but only if those future earnings projections are calculated very conservatively and the price paid still represents a satisfactory margin relative to those conservative projections. The real danger zone is when the market price flies far beyond any reasonable, prudent estimate of future growth. Prudent estimates, he stressed, should always err on the side of underestimating the future. Be conservative.
Okay, and how does this connect to diversification?
Graham saw diversification primarily as an insurance policy, spreading risk so one bad outcome doesn't sink you.
Yeah.
But it's most effective when you're diversifying within a group of securities, each of which you've selected, because it offers its own margin of safety.
So not just buying lots of different stocks, but buying lots of different undervalued stocks.
Ideally, yes. Just holding a single stock with a large margin of safety might work out, but holding several, each selected with a margin of safety, makes a satisfactory overall outcome much more probable. If you just diversify across a group of stocks that are all overpriced, diversification itself doesn't solve the fundamental problem of overpaying. Wise individual selections matter.
Ultimately, Graham uses margin of safety as the dividing line, doesn't he? The criterion to separate true investment
Which rests on definable mathematical quantitative criteria,
from speculation.
which is essentially a bet without that built-in buffer of value exceeding price.
And he points out these interesting fair weather investments. What are those?
These are opportunities that really only appear after a market has crashed or corrected significantly.
Yeah.
A stock or bond that was purely speculative at its high price might now, due to the huge price drop, trade at a level that offers a large margin of safety based on its underlying, enduring value.
So the crash itself transforms it from a speculation into a potential investment.
Exactly. For the investor who has the cash and the courage to act, it's the complete opposite of most analysts recommending buys at the market peak and then telling you to sell on the way down.
He briefly mentions special situations, too.
Yeah, things like merger arbitrage, betting on announced mergers closing successfully, capturing the small spread between the current price and the deal price. Graham saw these as part of an unconventional strategy, primarily for the sophisticated, enterprising investor. He specifically noted merger arbitrage was probably inappropriate for most individuals due to the complexities and risks involved.
So circling back near the end here, Graham keeps returning to this central theme, the investors' chief problem, their biggest hurdle.
Mhm.
It's likely not the market itself, is it?
No, it's themselves.
Your worst enemy, he says, is likely you, exposed to the intense excitement, the greed, the fear, all the temptations of the stock market. Emotional control becomes paramount.
He truly believed that ordinary people with the right temperament for investment patience, discipline, rationality, humility are more likely to make and keep money than even brilliant people who lack that emotional control. Temperament trumps raw intellect in this game, in his view.
That's a powerful thought. So what kind of results should you expect if you follow Graham's approach? He has that famous quote.
Oh yeah. To achieve satisfactory results is easier than most people realize, but to achieve superior results is harder than it looks.
Let's unpack that. What are satisfactory results?
Satisfactory results, he believed, come from understanding your own limitations, confining your activities to that safe, narrow path of standard defensive investment guided by his conservative principles. Don't try to be a hero.
But superior results consistently outperforming the market is really hard.
Extremely hard. He points to evidence like most mutual funds failing to beat the S&P 500 index over time, or studies suggesting that even random stock selection can sometimes perform as well or better than professional picks, especially after costs.
So outperformance through skill is rare.
Very rare and hard to sustain. And often, underperformance is directly linked to the higher operating costs and trading involved in trying to achieve that elusive outperformance.
This naturally brings us to Warren Buffett, right? Arguably Graham's most famous disciple.
Absolutely.
Yeah.
Buffett calls Graham his teacher, the second most influential person in his life after his father. He credits Graham with providing the sound intellectual framework for his own incredible success. He highlighted Graham's amazing intellect, yes, but also his ability to apply that knowledge broadly and practically.
And Buffett's famous Super Investors of Graham and Doddsville lecture really drives this point home, doesn't it?
It really does. He uses that great coin flipping analogy. You'd expect some people to get lucky flipping heads 10 times in a row just by random chance in a huge population. But when you see a statistically impossible concentration of incredibly successful investors, all coming out of one small intellectual village, Omaha, all trained in Graham's value investing methods, Buffett argued it wasn't random luck. It was the result of applying careful analysis and understanding that critical relationship between price and value. The method worked.
And Buffett has his own brilliant analogy for the margin of safety, the bridge one.
Yeah, it's fantastic. He says you build a bridge designed to carry a 30,000-pound load, but then you only drive 10,000-pound trucks across it.
Lots of extra capacity.
Exactly.
Yeah.
Applied to investing, it means you don't pay $80 million for a business you've carefully valued at only $83 million. That's cutting it way too close. You need a much wider buffer, a bigger gap between the price you pay and your conservative estimate of its value. It just hammers home that value is paramount, not just the price tag the market puts on it today.
It's also interesting how Buffett maybe adapted Graham's wariness of goodwill giants, those companies where the price far exceeds the tangible book value.
Right. While Graham really preferred that tangible asset backing, Buffett finds a margin of safety in some of these large, seemingly expensive companies if they possess what he calls a durable competitive advantage.
A moat.
A moat, exactly. Something Graham touched on with companies like Coca-Cola even back then. Buffett looks for that competitive protection that safeguards their future earnings power. That becomes a different kind of buffer, a qualitative margin of safety based on business strength, not just assets.
So as we wrap up this deep dive, we've really explored the core concepts from the Preston Pysh and Stig Brodersen summary of Benjamin Graham's enduring work, The Intelligent Investor.
Yeah, it's been quite a journey through his thinking.
We've looked at that foundational distinction between investing and speculating, the critical need for emotional control, the power of sticking to a sound strategy.
Understanding different securities and their risks, how to approach stock selection with those conservative criteria.
And of course, the absolute non-negotiable necessity of the margin of safety.
Hopefully, this journey through Graham's principles via the summary has given you a clearer map for navigating the market and maybe provided some practical aha moments about value, risk, and perhaps most importantly, your own role in the whole process.
The central message seems remarkably simple on the surface, yet profoundly difficult to execute consistently. Successful investing isn't really about having the highest IQ or finding complicated formulas.
No, it's about discipline. It's about understanding value, applying a conservative framework, demanding that margin of safety, and mastering your own behavior when things get scary or exciting.
So to leave you with a final thought for your own investing journey, consider Graham's observation again. Satisfactory results are easier than most people realize, but superior results are harder than it looks.
Given that reality, how might shifting your focus primarily to avoiding the big mistakes, the kind of catastrophic errors that a margin of safety is designed, protect you from be a more reliable path for you than constantly chasing those potential home runs?
Think about Buffett's bridge analogy again. How much excess capacity, how much buffer do you really want built into your own investment decisions? Something to mull over.